All right, so the United States is officially at war with Iran. The headlines are everywhere, and a lot of investors right now are asking the same question. What does this mean for my portfolio? So, in this video, I want to slow down everything. I just want to give a clear breakdown of what's happening in the markets right now, what usually happens during conflicts like this, and most importantly, what this means if you're a long-term investor. So let's break it down. First, let's address the immediate market reaction. Whenever a major geopolitical conflict breaks out, especially involving a country like Iran, which has a big role to play in global energy markets, the first thing the markets react to is the uncertainty. And uncertainty creates volatility. Since the conflict began, we've already seen broad indexes pull back, not collapse, but noticeable selling pressures. And that's normal. Institutional investors de-risk, funds rotate capital, algorithms adjust to higher volatility. This isn't the markets ending, it's just the markets repricing themselves. Now, the biggest driver behind this reaction has been oil. Iran is strategically positioned near the Strait of Hormuz, one of the most important oil shipping routes in the world. About 20% of the world's daily oil passes through this strait. So when war breaks out in that region, oil traders immediately price in the possibility of supply disruption. And that's what we've been seeing. Oil prices have started to tick up, and higher oil prices mean higher transportation cost, higher manufacturing cost, higher fuel prices for consumers, and that can all increase inflation pressure. When inflation pressure rises, markets start worrying about interest rates, consumer spending, and corporate margins. So that's why you're seeing pressure in certain sectors. Airlines are down, travel stocks are down, some consumer discretionary companies are pulling back. Fuel is one of the biggest expenses for airlines, so when oil jumps, airline margins get squeezed almost instantly. At the same time, though, not everything is failing. Defense stocks are up, and that makes sense. Governments increase defense spending during active conflicts. Investors anticipate larger contracts and more demand for military equipment and technology. And energy companies are also moving higher because higher oil prices increase their revenue in the short term. So, if you're in a diversified portfolio, typically broad index funds, you're likely seeing a mix. Some things are red, some things are green, and there's a lot of volatility. That's how sector rotation works during geopolitical events. Now, here's the part that really matters. Short-term market reactions are emotional and aggressive, and they're often driven by worst-case scenario pricing. So markets don't stay in panic mode forever, though. Historically, when wars begin, the market drops first and then begins to stabilize as more information becomes available. Why is that? Because markets price uncertainty quickly, but once the unknown becomes known, even if it's not ideal, the investors can model it. So, unless a conflict completely destroys the global economic system, which is extremely rare, businesses continue operating as normal. Innovation continues, earnings continue, growth continues, and that's what drives up stock prices long term. Now, I want to talk directly to long term investors for a second. If you're investing for retirement and your time horizon is 10, 15, 20 years, if you're consistently contributing to index funds and diversify your holdings, this moment may seem a bit uncomfortable, but it's not necessarily catastrophic. Volatility often feels worse than it actually is. The big risk right now isn't that the market moves down temporarily. The biggest risk is making an emotional decision, like selling all your stocks, moving to cash, and trying to time the bottom of the market. Because historically, the investors who lose the most during geopolitical shocks are the ones who panic sell and then miss the recovery. And recoveries often happen faster than most people think. Now, that doesn't mean ignore the reality. Could this conflict escalate further? Yes. Could oil prices stay elevated for a while? Yes, those are real risks. But here's the key distinction. Short-term economic pressure is not the same thing as long-term market destruction. Markets are forward-moving machines. They consistently price in probabilities, and right now, they're pricing in war risk, oil disruption risk, and inflation risk. But over time, as more clarity emerges, the pricings adjust. So, what should you actually do? First of all, do not panic sell. Second, make sure your portfolio is diversified. Third, rebalance your portfolio if necessary. And fourth, check your risk tolerance. If today's volatility is making you lose sleep, that might mean your portfolio is too aggressive for your comfort level. That's a strategy issue, not a war issue. Sometimes the biggest lessons during moments like this aren't about geopolitics. They're about understanding how much volatility you can realistically handle. Now, here's something that might seem counterintuitive. Most periods of geopolitical stress sometimes create opportunity. When fear is high, quality companies can trade on discounts. Long-term investors who continue contributing during downturns often benefit from lower entry prices. This is why it's so important to understand how markets function. They normally overshoot in both directions, up and down. So let me summarize this clearly. In the short term, we get volatility, oil spikes, sector rotation, and emotional headlines. But in the long term, we get adaptation, stabilization, we get earnings growth. But the question you have to ask yourself is, will this matter to my portfolio 15 years from now? History suggests that for diversified long-term investors, the answer is usually no. It will show up as a dip on your long-term chart and nothing more than that. And remember, markets have moved through world wars, recessions, oil shocks, financial crises, pandemics, and political instability before. They have never moved in a straight line. But over long periods, they have moved upward because economies grow and businesses innovate. Right now, the headlines are pretty loud, but investing is about discipline. And discipline during volatility is what separates short-term traders from long-term wealth builders. So stay calm, stay rational, stay diversified, and remember that volatility is part of the process, not a signal that the system is breaking. So that's all I have for this one. If you found this video helpful and want more breakdowns of how major global events affect your investments, make sure to like and subscribe and drop a comment for video suggestions and games you'd like to see me play in the background. Of course, all this is for entertainment purposes only and not financial advice. So until next time, keep stacking that cash.